Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hi there. Welcome to the Business Line State of the Economy podcast. This is Nabodita Ganguly. Our guest today is Anurag Mittal, Head of Fixed Income, UTI Mutual Fund. Today we will be discussing about the central bank policies, interest rates, currency, bond yields, and much more in this podcast. Listen in. Hi Anurag, thank you so much for joining us.
Thanks a lot, Nabodita, for inviting us. Thank you.
So Anurag, now the RBI monetary policy is the talk of the town. So let's begin with that. Will inflation and price stability continue be the core focus area for the RBI? How will things go?
Right. So I think given that growth, is at a very good level, even compared to RBI's forecast now for consecutive 2 quarters, and even the outlook for future growth is also quite stable compared to some of the global central banks where outlook for growth is now weakening. And even if you look at the trajectory of inflation for RBI compared to some of the other global central banks, we have been seeing one-off food price shocks at different points of time due to some issues in supply chain, sometimes due to erratic rainfall, etc. And even going forward, at least in the next couple of months, we may continue to see some food price pressure. So while core inflation is quite encouraging, but nevertheless, food price continues to be a concern for RBI. And we believe that RBI will take its time and they will want to focus on price stability, and they may continue their stance on policy rates as well as liquidity till they see a decisive disinflation on food front.
So now talking about interest rates, when do you think interest rates will begin moving lower?
Right. So if you look at what RBI has been saying all along, RBI has been maintaining that their inflation target is 4%. And if you look at the last couple of years since we have been exiting the pandemic, inflation has been at 5% and above for a while now. So we believe that at least RBI will want to see inflation uh, at least near to 4, if not 4, before they have a confidence that they can start cutting interest rates, or they need to see a large growth shock where the policy focus shifts away from price stability to growth stability. Given that growth stability is not really an issue right now, we believe that probably RBI will be in that position where they have more confidence on inflation in the second half of the calendar year 2024. So probably somewhere between June to August is where we think that RBI will be in a position to lower policy rates. But mind you, uh, the rate cuts that we will see probably from the advanced economy central banks such as UK or the ECB or the US, we may not be able to see those many rate cuts in India because the level of inflation and the level of rate hikes that have happened globally, they have been quite significant compared to their past 10-15 year trend. And but if you see RBI is not way above the pre-pandemic levels. So probably it will be reasonable to expect a 50 to 75 basis rate cut in this monetary policy cycle when it starts, like I said, again in 2024.
But talking about the rate cuts, in case consumption starts taking a hit due to higher
Right.
rates, do you think
Right.
there will be some pressure on the RBI to cut the rates?
While consumption may slow down in the near term because of tightening of financial conditions or because of the base effect, but I think there is slight nuance there that one, there a certain slowdown is expected, in the regular course of time, and probably the slowdown that will happen in consumption will not be material enough to bring inflation and inflationary expectations down. So if you see the core inflation is already close to 4%. so the consumption, it's not that the consumption is a problem for inflation right now. So even if the consumption continues to slow down from these levels, which is expected to, it may not result in a major disinflation in the economy, because most of our inflation is supply side. So what it broadly means is, in a supply side inflation, why RBI may not need to hike rates, because it is again, largely supply side. But they can also not cut rates, because what happens is sometimes these repeated supply side shocks often tend to translate into second round impact on inflation, and also they result in an anchoring of inflation expectations, which RBI probably wants to avoid.
So now moving to the Federal Reserve for that matter, as you mentioned that the way RBI is functioning and the way UK or USA will function will be pretty different. So do you think
Right.
there will be one more 25 basic points hike in December, or do you think that the rate cycle for the Federal Reserve is done for now?
So if you look at the US price as well as employment data, which the Federal Reserve has been looking very closely, that's clearly indicating a loss of economic momentum. And if you also look at Fed's, various governor statements in the last couple of months, they are also giving a lot of weightage to the tightening of financial conditions, because the way interest rates moved up across the curve, uh, for them. So probably at this point of time, we do not expect a rate hike unless and until there is a major price shock in the next, let's say, next month, which is unlikely at this run rate. But so we largely believe that, at least for the US, the rates have peaked, and at some point of time, even the US will be looking at cutting interest rates.
So, talking about cutting interest rates, when you see the rates moving lower, like, is it happening anytime soon? It doesn't seem like that, right?
Right. So we also have to remember that central banks are also trying to bridge their credibility deficit. So if you remember the first half of 2021, when most of the central banking narrative was that inflation is transitory, and which it wasn't, because of repeated supply side shocks, they want to be very careful, and they want to be more sure before they start cutting policy rates. So we believe that probably Federal Reserve or any other central bank, barring a major economic shock, which could be a financial shock or a sovereign shock, other than that, they would want to see at least the incoming data for 3 to 6 months before cutting rates. And if you look at the sequencing of events, so if you look at the situation, most of the central banks, whether you look at RBI or other global central banks, they are on a hawkish hold or on a withdrawal of accommodation phase. So the first sequencing will be probably change in the policy language, change in the way they are managing liquidity, and then probably they will move on to the easing of monetary policy, which will be a natural extension of these measures of overall loosening of financial conditions in the economy.
So it sounds like it's a long way to go, basically.
Uh, I think central banks will want some hard evidence and a longer trend of disinflation before they take more action, because in the last 12 months also, if you see, there have been many false flags where there have been narratives that a hard landing is nearby or a major growth slowdown is nearby, and just in a couple of months things have been different again, and the economies globally have been much more resilient because of very strong household savings, very strong government uh, capital expenditure, whether in India or in globally. So given that there have been a couple of false flags in the past, we think yes, the monetary easing is some way to go before we can say that rate cuts are much more near us, and probably we can look for further rally across bonds.
Now, talking about dollars, what's your view on the dollar? Will it weaken further from this level? And what are the implications of it for the Indian rupee?
Right. So we don't trade dollar actively. We largely try to understand the trends for dollar rupee, just to take into account how it works into our inflation slash growth assumptions. If you look at the dollar, what really will be critical for dollar will not just be how interest rates or growth pans out in the US, but also how growth pans out in the Eurozone, or how inflation pans out, for example, in Japan, which are the other major trading currencies which are relevant for dollar movement. So if you look at Eurozone, even right now, most of the economies are now facing recessionary pressures in the Eurozone. So, in fact, if ECB were to cut rates first, then, or before the US, and the growth drivers in the Eurozone would be weaker, then probably dollar could continue to remain stable. So the normal thought process is that if the US is cutting interest rates, if inflation is slowing down, if growth is slowing down, dollar should weaken. So I think that is a slight, I think, difference in this uh, in this monetary policy cycle, that Eurozone seems to be in a much weaker position as far as growth is concerned. And even if you look at inflation, the disinflation in the Eurozone is also much sharper right now compared to the US, because of the consumption engines there being much more weaker again compared to the US, because US had the benefit of very high fiscal stimulus, as well as the US consumer did not really face the shock of the Russia-Ukraine war. So that's why the US household balance sheets are much more stronger. So probably if the Eurozone continues the way it is doing, we may not see too much of relative depreciation in the dollar. Also, secondly, on the how we would looking at Bank of Japan policy, if even if BOJ continues the way it is doing, and yen continues to remain at these levels, again, because the Bank of Japan continues to exit its accommodative monetary policy very, very gradually, then again we would see dollar continue to remain stronger than the major currencies.
I just had a follow-up question. With this concept of de-dollarization being followed by so many countries, so many talks about dollar not being the single like supreme monopoly anymore, do you think that will have an overall impact, or is it just something that we are talking about, or is it something that's actually happening, with it actually making dollar not as strong as it was ever?
Right. So it's a very interesting question, and thanks for asking that. But if you look at the global trade denominated via dollars, or whether you look at FX reserves denominated in dollars, and if you compare today's reserves or global trade compared to last 20 years, in fact, the share of dollar has gone up. Is the share of pound and the share of euro is actually come down, and that has been replaced by RMB, but largely, dollar has maintained its dominant status, whether you look at reserves or global trade. The reason being, uh, you know, even today, there are not too many alternatives to the US, where a cent. And if you look at the requirements of any holder of a foreign currency, whether you're looking at a transparent economy, whether you are looking at an economy which is fully convertible, which is more rule based, I think there are still not too many alternatives when you compare dollar to other major global currencies. So at least I think it's still some time away. There are talks going on, but we still think that at least in the near to medium term, dollar's dominant status is not really going away.
So we'll wait and watch. Maybe it's a discussion for later we can have.
Sure, sure.
So now talking about Indian bond yields, people are talking about it a lot, about how it's pretty strong, how it's very attractive. They have remained fairly stable over a period of time.
Right.
So are there chances of them declining going forward as inflation dips?
So Indian bond yields are relatively attractive in the sense that given that we are expecting policy easing in the next 6 to 9 months, there is a scope for further rally in bond yields. Also, the inclusion of Indian bonds in JP Morgan Global Emerging Bond Index, which may lead to 20 to $25 billion of inflows, also reduces the demand supply gap that typically the bond market has been facing for the last couple of years, and it was largely reliant on RBI's OMO purchases or some other large intervention uh, to fill this gap. So yes, from a tactical or opportunistic perspective, bond yields may see some easing, but if you look at from a long-term trend perspective, uh, given that we are expecting a very shallow rate cut cycle, the scope for bond yields to fall will really depend on how far we are seeing disinflation in this monetary policy cycle. So, if we are looking at a 50 basis rate cut, let's say, in this monetary policy cycle, which basically means a repo of 6%, typically, in India, 10-year, for example, a government bond has traded 80 to 90 basis over the repo rate historically. So if you assume that premium, uh, it basically translates into a 680 to a 7% kind of a level, and we are right now trading close to 7 quarter. So yes, there is a scope for rally, but from a more medium term perspective, it will really depend on how far we are able to, you know, ease policy rates, which again ultimately depends on the level of disinflation that we see in the economy. At this point of time, it looks like on an average, the inflation may remain in the zone of 5% rather than 4%.
You explain that a bit, why 5% rather than 4% for that matter?
So if you look at the components of inflation, which is one, I would say the food inflation or commodities inflation, and the second you look at core inflation. So if you look at uh, in the CPI series, and historically, you are seeing core inflation at one of its lowest in this financial year, right? And so most of the disinflation in India previously has come on the back of lower food prices. Given that we saw a El Nino, monsoon during this year, and it's also expected that even the next year there could be erratic weather patterns, as well as there is a possibility of El Nino, at least initially, there we have to be open to the possibility that food prices may not come down very materially. And also now next year you are all facing the base of a lower core CPI. So, so probably it will be difficult in the near term for this inflation to come to close to 4% sustainably. So we may see some inflation prints in the 4% handle, but to see them sustainably at 4%, at least at this point of time, looks difficult.
So it'll be hard for the common people.
See, if you look at overall inflation, it's about 5%. We do expect some rate cuts even at this with this kind of average inflation, because like I said, the 5% number that we are saying is an average. It's not. So I think broadly, if you look at in this range of inflation, it's largely in line with what we have seen in the last 5 7 years, and it is an improvement of the COVID period where we were seeing inflation, in the range of 6% and upwards. So it is an improvement to what we have seen during the pandemic period. And mind you, this is also coming on the back of two large geopolitical conflicts, uh, right, and a lot of supply side shocks across the world. So achieving this kind of inflation at such a uh, volatile backdrop is also not easy, and it is quite that way. I think something to be expected.
Understood. Now, I think this last question is something that debt fund investors would love to know more about. What strategy would work best for debt fund investors in this current scenario?
right? So, typically when a debt fund investor is looking at fixed income, I think one of the primary reasons when they look at fixed income is that they are looking at stable returns. And typically when they compare fixed income mutual funds, they compare with traditional fixed income investment options. So we think for investors who are looking at stable returns, who are uh, comparing their fixed income mutual funds to other fixed income investment options, a moderate duration like a short-term fund or corporate bond fund, we think is quite suitable for investors who have more than 12 months investment horizon and some appetite for intermittent mark to market volatility. If you look at where the 3 to 5 year, let's say AAA PSU bonds are currently priced in, they are priced in somewhere between 770 to 780 kind of levels. So already if you see the correction in real yield for investors, it has happened meaningfully in the last couple of years. So today, if you assume an average inflation of 5%, a bond yielding at 780 with some opportunity to participate in capital gains when interest rates start to ease off, they do present, we believe, a suitable investment opportunity for investors without taking too much of a duration risk. So we think funds like short-term corporate bond, banking PSU, or other target maturity funds, they do offer an attractive investment opportunity for investors who have an investment horizon of more than 12 months. For investors who have an investment horizon of less than 12 months, they can consider ultra short or low duration funds, which broadly one they match their investment horizon and they may exhibit lower mark to market volatility compared to higher duration strategies. And they're also yielding quite attractively. If you look at today, the 1 year bank series, they are yielding somewhere between 780 to 790. So these are also quite attractive levels for investors to consider, even from a 6 to 12 months kind of investment horizon.
I think that's a lot to unpack for investors. That's really beneficial. On that note, Anurag, thanks a lot for your time. Thank you so much for joining us. I think we are all hoping forward to what the RBI says tomorrow. And I hope this will, whatever you said, will have a broader understanding and help people to decode what's happening. Thank you so much, Anurag.